Welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'm going to be your host for about the next 30 minutes here. We got a lot to cover today, mainly because we put on quite a few positions that were bearish in the marketplace, and guess what the market's done? September hit, and it was almost like a hurricane coming into your neighborhood and just slamming the market. I don't know why September seems to do it, but year after year, it happened last year too, the first day in September, the markets get just even a smidge of bad news and it gets taken very hard. And that happened this month too. We had special guest Russell Rhoads, the king of the VIX, on our show not that long ago. And on that day, we decided to talk about the seasonality of the VIX. And we looked at a butterfly trade on that day in the VIX. And Russell gave me my first A+. He is a professor in Indiana. And he did give me, he did like the trade that we put on. And that trade is paying out. So we're going to review that trade and kind of decide what we'd want to do with it, to be blunt. We have a winner, but we have a lot of time until that expiration date. So reached our goal as far as what we'd want to do on the upside. And the rules of option trading say that if you reach your goal, you get out of the trade and you move on and you put on another trade. And so we'll look at it and we'll discuss it. And that's going to be part of the show today. And then on Wednesday, we decided to keep with that bearish mindset. And we looked at a trade. The markets were actually up for a minute on Wednesday. I think it was about one of the only minutes so far in September. Remember, we had the market holiday on a Monday, and then so we didn't come into September until Tuesday, which was the 3rd of September. But the markets have really struggled to have a positive day. They've had moments where the markets have been up, but right now we have the S&P 500 index down 46. We have the NASDAQ down 350. We have the Russell 2000 down 20 cents on the day. And so the markets, once again, are just struggling to go anywhere. And that has driven the VIX index up to 2160. So let's start with the VIX trade. And we've looked at this a couple of times already, kind of talked about the fact that, I mean, when we put the trade on at the end of August, we basically, to be blunt, I planned to have Russell on the show at the end of August because we put together a seasonality chart looking at the VIX going back approximately 20 years and just highlighting the fact that September and October, just time and time again, have the VIX has spiked and just underperformed relative to the other 10 calendar months of the year. So we put that trade on. I think it was the 26th of August that Russell was on, which was a Monday. And here's what our VIX trade was and is, because the position's still rocking and rolling. Right here, VIX is at 2183. We went to the September 18th expiration, and I always like to just draw attention to this, a little bit repetitive if you follow Options Guide TV a lot, but these are the weeklies, and the weeklies just aren't as liquid in the VIX. I do everything I can to try to trade the actual VIX options, the ones that were originally introduced, and these are the once a month option contracts. They usually expire in the middle of the month, and they stop trading on a Tuesday, and the settlement is decided on a Wednesday. Okay, so that's the September 18th contract. That's 12 days away. That's what we decided to trade, and that's my only reason for even talking about, do we want to stay in the trade, because we have such a long time remaining to that expiration date, and butterflies want time decay. So the only thing that we probably did, if you want to say wrong on the trade, is we gave it too much time. I didn't mind it. I want to trade in that month, the 18th, and I would have done it the same way if we're looking back again at the trade. There's hindsight's 2020, but The VIX is at 2207 right now, but the VVIX, which is the volatility of the VIX, in other words, it's the VIX is representative of the SPX options. The VVIX is representative of VIX options. So it's the volatility of the options in the volatility index. If you got to say it slow in order for it to kind of set in a little bit. And that spiked up, and that's at 121. So that hurts our position too. That was down around 100 when we put the trade on. 20 points movement is nothing to sneeze at, but the delta or the pricing aspect of the option contracts that we choose is definitely winning over these factors. We don't have a lot of time decay. We got a spike up in the VVIX, which would be understandable. We would expect that spike in the VVIX if we were correct on our forecasts. We knew that was a little bit of a headwind. Okay, so we bought the 18 strike. We sold the 24 strike. The market was down around 16. I think it was right about 16 when we put the trade on. Market is now at 22, but that's not necessarily the market, right? Because we talked about the fact that it's the VIX futures contract that drives these options as opposed to the actual spot, which is the VIX index. Now, I promised an article. I'm going to post it today on x.com that kind of goes into the details about VIX futures. So I'll post that today if you're watching. So keep an eye on my X feed, which is at Brian Overby, and I'll push that out. Also, it'll eventually be up inside the Tradier Hub. It'll be a part of the profile for Options Guide TV. Okay, here we are. 22 is where the market is at. So to really figure out where the market is at, what you need to do is see where the call and the put lines up. And this one is fairly close here, right? Now you're looking at the bid of the call, that's at 209, and the bid and the ask of the put, which is 205. So just by looking at that factor, you know that the futures contract is somewhere around 20. The VIX is at 22, which would kind of make sense to me that it's usually doesn't, the big spikes up in volatility, the futures are less, a little bit muted relative to the actual spot. Now, as expiration approaches, the VIX, the spot, and the futures have to come in line, and the actual VIX index determines the settlement value on that expiration date. So quite simply, you just go down, you kind of look at where do the call and the put line up, and you realize that that's approximately where that is trading. Now, other thing you can do is you can go to the Chicago Board Option Exchange if you don't have a futures account, because you're looking at VIX futures, and you can get a delayed quote. So if you type in CBOE delayed quotes on VIX, it will give you that quote, and it'll be 15 minutes delayed, but that would be another way to look at it and see where it's at. Now, I mentioned this a couple of times, but I'm really annoyed because I was on the retail markets committee for the Chicago Board Option Exchange when I was working for a brokerage firm, and I got them to actually put VIX SEP and actually quote the VIX futures, and all of a sudden they just stopped. I tried to get an answer and I couldn't, but for some reason the powers that be decided that you can't type in VIX SEP and actually get where the futures contract is at. So it's, I think, the only product on the CBOE where they actually don't quote the underlying for the option contracts that they're trading. That's for a different day, right? Okay, so VIX is actually going up more now. It's at 22.53. Yeah, and the futures moved a little bit. So bottom line is we look at our trade. Bought the 18, sold the 24. We can get out for 120. We put it on for about 30 cents. We're up 90 cents on the trade. That's more than enough to be up on the trade. You have 12 days remaining. Normally would just flip the script, make this a sell, make that a buy, and just get out of the trade and close it and go on. If I have, which I do, if I had a 10 lot position on, I would, at this point in time, maybe sell half of it, because time decay is such a big factor. the only thing about it is we got 12 days, and the VIX can move so much in 12 days. So sometimes the VIX is a real tough one. If I'm in the SPX and I got a butterfly that's winning, I'm more apt to mess around with it, right? Because you feel like there's a little bit of predictability in the SPX. The VIX, there's no predictability where it's going to next. So I would sell about half of the position and then let the second half ride, and at least for a couple of more days, because every day that goes by is a huge amount of time decay, which is going to help you in your profit and loss graph. Now, so I'm going to send this, I'm going to look at it in the what if calculator. And here was our trade. This is going to be representative as of today. So it's going to show the 121 debit. But here's where the trade was at. We put it on. The VIX was down here. From 18 all the way up to 24 were profitable. And then actually from 29 and beyond were profitable, because we did it for a much lower debit in the account. Now we would be down on the trade if we did it. So I wouldn't suggest putting it on. But that is the way that we put the trade on. And we did that by adjusting the strike that we bought. We paid a little bit more for the VIX when we put it on, or for the butterfly that we put it on. I would actually call this a modified butterfly, not a skip strike. I would call it a modified butterfly, because I have a specific definition in the playbook for a skip strike. And this is 5 points wide and this is 6 points wide. That's simple. Because it's 5 points wide on the short spread, that means that we had unlimited upside. Well, not unlimited upside. No matter how high the VIX went, we were profitable on the trade by making a small adjustment and paying a little bit up front. On the downside, it had to get above 18. We were at 16. It had to get to 18 and go beyond. And now we see the VIX probably in the futures trading right around here, right around this area, probably where the futures contract is at this point in time. All right. Now let's look at the trade that we put on Wednesday. So let's stay in the what if calculator. Oh, by the way, if you have any questions and you are in the Tradier Hub and signed in, you got to be signed in. You can ask those questions. Or if you're in the YouTube platform and you're signed in to your YouTube profile, you can ask questions inside the chat box. I'll be happy to try to address them on the show. And if you're on X.com, thanks for joining, but you can't participate in the reindeer games. There's no way to ask questions via the X platform. Okay. What if? SPX, long butterfly, zoom down. I think this one I already zoomed out on. There we go. So the same trade, we did the same trade, modified the butterfly, gave ourselves profitability on the downside, and we were doing this in the SPX. So the profitability was much different in that instead of being able to make $1, basically minus the net debit paid in the VIX trade, we were able to make $5 minus the net debit paid in the SPX trade. Well, as I mentioned, the SPX has done nothing but gone down, and the VIX has done nothing but gone up since September. So we are all the way down in this range. And if you flip the script on this is as of today, we are actually up 250 on this trade. Now, there's no reason to get out of the trade. So let's go back and look at, let's send this. This is what I want to do. Let's take this and we'll just put it in this way. If we click on this, we can send this to the order ticket. And you see that this is trading right around $5. And that's where it should be trading at. There we go. And so if we're in the SPX, we can set the trade up real quick. We did the 0 days to expiration. We put the trade on for $2.50. If the market came up on Thursday, we had an adjustment we're going to put on, but we didn't really, there was never a chance to really adjust to put on the trade. We paid the $2.65. SPX options settle in cash. The market was at 55.40, right? And it's 54.30. So it's down 100 points since we put the trade on. Suppose we can take a picture of the chart a little bit here. Or take a look at the chart, I should say. And NVIDIA down more today. Actually, I haven't even looked at NVIDIA today. Okay, so here is the area that we want to zoom in on. And right around here, right, this would be right at the 200-day moving average. Yeah, right about there is an area of support that I wouldn't mind getting long at, honestly, if we wanted to uh, look at a different position of it. But that's quite a bit down. You're talking, gosh, 300 points. That's quite a bit down in that area. Even right around 5,200 would be an interesting area too. But with that said, this is what we've done in the market. We had one little blip of an up day that was on the 4th, and it just didn't last for very long. The third down, and here's the 5th we're down, and now we're down even more in that range. And so now we have this trade. We're trading at 440, 470. I don't know how I'd say that, but the maximum the trade can make is 5 points. And here's why. Maybe I should put this in here though. Let's go. Oh, there it is. Good. Beautiful. So here's why. This long spread in our trade, we put this on for $2 and let's call it $2.50. Let's call it $2.50 just to make it simple, because that's half of what the maximum we can make on the downside. So there was an opportunity when the market came down to potentially get out at a higher price. Not quite sure where it would have been at. I didn't necessarily look at it. I didn't put this trade on in my account like I did with the VIX trade. So 55.10, and it came down to, I feel like that was 15 points. Let me make sure I got that right. I feel like it was 15 points. 35. Yeah, okay, I'm going the wrong direction. There we go. That's 10. Okay. So 55.35 to 55.20 is 15 points, right? In order to make it a standard butterfly, which means you pay a net debit for it and it's got to land within the rings, you would normally go down to the 55.05, which is 15 points below. But we didn't. We went down to the 55.10. So that's 5 points difference off of a standard butterfly. By doing that, we say from 55.10 on down, we actually make 5 points, or we could sell it. I should say, for 5 points. We paid $2.50 for it. We sell it for 5. We make $2.50. Now it hung out around the 55.20. So let's go back to the chart. So in this range, came all the way down. Well, right. I guess we weren't there that long. There's not as much of a tail on it, but it was at the close. And then actually all day long, this is just a boring market on the 4th. So yeah, there was probably opportunity here to get out of this trade at a decent, maybe even more than sell it for more than $5 at that point in time. But now you got the position on, you're up 250 on it. You have no risk if the market goes lower. Can't lose the 250. All that can happen at this point in time, because it's got one day to live, as long as you don't fall asleep on the couch and wake up and the market bounces all the way back to 55.35 and beyond, ideally you would like the market to start creeping up. And it's not doing that. It's creeping down. It's actually down 1.5% at this point in time. But ideally, you would like it to land somewhere within the strikes. So no risk. All you do is watch it and let it go all the way to expiration, and cash ends up in your account where option contracts used to be, and you would be up 250 on that trade. All right. So let's do a rinse and repeat. I still want to stay bullish in the market, and we're going to do the same trade, and we do have an adjustment. I'd like to put these on Monday, but let's put one on Friday. Usually Mondays couldn't be big down days, so I don't mind putting on bearish butterflies over the weekend. If I was bullish on it, let's say we're going to flip the script and actually become bullish on the trade. I would be more apt to do this than on a Monday than on a Friday. Mondays have a tendency, if we do have down days in September and October, the big days have always been on a Monday. Okay, here we go. So we're going to go out to the following week, which would be September 7th, 7 days away. We're going to go down. I like the 5,400 area, but let's try 10 more points down. We're down 82. Yeah. How far? I think when we first put that other trade on, we were, only 5 points. So let's go 10 points here. Let's buy this one because we're going a little bit. We got a lot more time. So that changes everything. We got 7 days as opposed to 2 days when we first set it up. We're going to do this contract. We're going to go 15 points. We're going to sell 2 of the 5,400s. And then we're going to go 10 and we're going to buy one of these. Okay, so we're putting this entire trade on for $2.10. So for every 1 by 2 by 1 butterfly that we put on, we're going to risk $210. The maximum upside, the maximum this could trade for is $15. But you're never going to get that because you're not going to ride this. If this thing goes to 5,400, that's where it would have to go to be out right at expiration. And let's send it to the what. It's easier to explain if I send it to the what if calculator. I don't know why I'm messing around trying to explain it without a picture. Picture's worth 1,000 words, they say. Let's hope this picture's worth $1,000. Okay, market is right here. Here is our graph. As expiration approaches, if we go down, now this shows you that we're paying, well, it's saying 225. We looked at it at 210. It's bouncing around. This is assuming that we paid 225 for it. And that means that if it goes all the way down, we make 275. So we're here. We land within this range. This looks pretty beautiful right there. That's 1,275. But once again, you're not going to ride it and all the way to expiration and make the maximum profit. If you do, you kind of should get the stupid award for it, honestly, because you should have been out earlier. Market comes all the way down. We're still looking real good within these ranges. And if it comes all the way down, oh, well, we made 275 on the trade. I still like it in the September and October market. So we got long VIX and we've been short SPX. And on both cases, they've played out. Good week on Options Guide TV. Learned a lot about these trades, the pricing and how they work. The VIX trade, got to decide if you'd want to get out of it. That's a tough one. Like I said, if you had one lot on, if you had one position on, I would probably get out at the end of the day, not take the risk over the weekend. It just kind of makes sense. If you have a 10 lot on, don't mind selling half of it and then let the other half ride and see where we're at next week. And let me check if we have any questions. And I don't see any. So thank you for stopping in for Options Guide TV. We'll be back next week. We will obviously follow this trade all the way through and keep our bearish stance. Don't really want to get long until the election happens. And then we'll look at a lot more, even deep in the money call options once we get that big unknown out of the marketplace and out of the way. That headwind, I guess, is the way that I would, is a better way to say it. See you this Monday, 11 a.m. for the next edition of Options Guide TV. Stay tuned to hear a little bit about the Tradier and CBOE Option Summit.
Capitalize on stock market uncertainty this coming election. When most see disaster in the headlines, informed traders see dollar signs. Elite traders have embraced market fear for decades, and now you can too. Join us at our exclusive Fall Tradier Virtual Summit, sponsored by CBOE, on Wednesday, September 18th, 2024 at 10:30 a.m. Eastern Time. Claim your seat at summit.tradier.com before registration closes.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.